As always, please keep in mind that I am not a financial advisor. The content on this channel and on my website is intended for educational and entertainment purposes only. Hey guys, welcome back to the channel. Today I want to talk to you about the so-called payout ratio, which is a ratio that many dividend investors look for and what many researchers also use to check if a company is a safe dividend payer. And I am a firm believer that the way the payout ratio is calculated is wrong, in the sense that it just doesn't add up. Like, I can see why they do it in this way, but I wouldn't suggest it. Like, I really wouldn't suggest it. So in this video I'm going to talk to you about what I think should be the way the payout ratio should be calculated. So the original formula is this: the total dividends divided by the net income, and you get the dividend payout ratio. This formula is from the Investopedia website, and what this number is supposed to tell you, okay, how much of the profit or how much of the dividends are paid, what percentage of the dividends is paid compared to the profits that the company made. So let's say a company has €1 profit per share and they pay 25 euro cents dividends per share, then the payout ratio will be 25 cents divided by €1 is 25%, which would probably be considered a payout ratio that is safe. The moment the number becomes higher, it becomes less safe, and the moment it goes over €1 or 100%, I should say, it is considered not safe at all. Like, the company is paying more dividends than they're actually earning, so get out of the company. It's not safe anymore. So this one is from Yahoo Finance, and this is from DGOC. You all know DGOC, and it states that the payout ratio is 170 or 171%. So in this case you would say the dividend is not safe, get out of this company. However, and this is something that I would like to point out, the dividend is a cash takeout, it's not a cost. And this might seem a bit vague, but if we look at this part, yeah, so if you go to Yahoo Finance, you go to the income statement, here you see all the revenue and the costs. Here you see all the balance changes, it could be assets and so on. And here you see all the cash changes. So on the balance sheet you have a cash position, and in the cash flows you receive the cash, or you see how much cash has come into the company, whether it's operational, whether it's through investing, or whether it's through financing. That's what you see. So in my opinion, if you look at a payout ratio of dividends, you do not want to compare it to something on the income statement. You want to compare it on something on the cash flow. And if you don't really care about the operations, and for example the company's liquidating, and you just want to see, okay, how much cash are they actually paying to the shareholders, then you want to look at the balance sheet, because obviously if they have a big cash position and they're just going to give it to shareholders, then yeah, you want to see, okay, how much of the cash are they actually distributing. But if you want to look at it from a continuity basis, you want to compare the cash flow of the business and see how that compares to the dividend payout. So what I would suggest is, instead of a payout ratio, you go for a cash payout ratio. And what you do is you do the paid dividends divided by the free cash flow instead of the net income or profits or net profit, whatever you want to call it. And why is that? Well, the free cash flow is it's basically operational cash flow minus capital expenditures. I've talked about this many times. So you basically have all the money that's come in and all the money that we had to spend, or the company had to spend, to stay afloat and grow. And so the free cash flow is all the money that is available to shareholders, and then with that money you want to see, okay, how much dividends did they actually pay. Something else you could consider is, okay, well, they could decide not to invest in anything new, to have no capital expenditures, so I want my dividend to be safe based on operational free cash flow. So, or I should say operational cash flow, not free cash flow. So just change this free and operational. You can all find this in the cash flow statement, of course, and then you can calculate the cash payout ratio in that sense. So For DGOC, we don't have to calculate it because they have a distribution of dividend policy. That means that 40% of the free cash flow will be paid out to shareholders. So we know that the cash payout ratio is 40%, give or take. Like the effect could be like 1% higher, 1% less, but in general we know what it is. So we could confirm it, but I've already checked it several times and I know that it's correct. But let's have a look at some different companies to see what the normal payout ratio is and what the cash flow payout ratio or the cash payout ratio would be. So here we're looking at ExxonMobil, who has a payout ratio of 446%. So way more than they made profits. Seems crazy, right? Like, how can you pay so much dividends if you don't make that amount of profit? However, profit is not cash related. In profits, there is this thing called depreciation. So the moment, in this case, oil prices collapse and stuff like that, the assets that you will be depreciated, so they will lose value, and you will see that in the profit and loss statement. So the income statement. It seems crazy, right, to have a payout ratio like this, but we're going to have a look at the end and we're going to do the cash flow payout ratio or the cash payout ratio based on operational cash flow. I'm going to do it, and we're going to see the insane difference that it shows. Then here we have the Shell. So this is from Royal Dutch Shell. The payout ratio is not available. Why? Well, they're paying a dividend even though they lowered it, but their profits have been negative because of all the depreciation. This one is also pretty insane. So this one basically shouldn't be paying. Based on conventional wisdom, I guess they shouldn't be paying any dividends because they don't make a profit. But if we look at the new formula, we will see an entirely different number. And lastly, I want to throw you a curveball here, and we're going to look at Microsoft. So here we're looking at the Microsoft payout ratio, which is very safe, obviously, 33%. But even in Microsoft, we see a slight difference. So that's going to be interesting as well. So here you have the three companies that we're looking at, and obviously DGOC we have already mentioned and checked, so we know what the payout ratio is. We know this payout ratio was 170 plus. We know that here is about 40%. But ExxonMobil, over 400% payout ratio, but if you look at the operational cash payout ratio, it is about 82%. Still very high in my opinion, but shows an entirely different number. And in my opinion, this number tells you something that you don't even know if you need to worry about it. This number, okay, this may be something that you need to worry about. Royal Dutch Shell didn't make a profit, not available. However, the operational cash payout ratio is about 25%. Very safe. And they lowered it this year, or this quarter I should say. And this makes you question, was it necessary that they lowered it? This is something that if you're interested in that, you could look into that to see how much they lowered it, and then obviously multiply it by the number, see if it's still safe. Lastly, Microsoft, 33% payout ratio based on profits. Sure, with Microsoft, it's going to be very hard to see an insane amount of depreciation. However, there could be other stuff to affect the operational cash flow. So for example, sure, it could be some depreciation on goodwill or something like that, or amortization I should call that, or they could just have received more money from their accounts receivables, and then their operational cash flow is higher than their profits in that quarter. But if you look at this number, 33%, and then you look at the Microsoft operational cash payout ratio, you notice that it's about 20%, so a lot lower than what you would see here. Is this crazy, or is the conventional payout ratio that crazy, like that unreliable? I wouldn't say no, because I would say no, I guess. Why? Because if you have a payout ratio based on cash flow, you do not take into account what they have previously spent on investments. Like in my case, I want to know what they are going to spend instead of what they have been spending. So I want to look at the operational cash flow minus capital expenditures. But if you feel like, okay, I want to see the payout ratio compared to their entire investment in the past, and I want to take into account the depreciation, then you need to take the normal payout ratio. The drawback that we have just seen, if there is some crazy world event that causes any asset to depreciate, then you will receive very mixed signals. You can have a look at real estate assets as well in this regard, and then you obviously, if you own a commercial real estate shop, then the asset will be depreciated because of the current economic environment. But if they still pay a dividend somehow, like I guess some still do, and you check that to the operational cash flow, then you might see, okay, well, it is actually still pretty healthy. And in the case of real estate, you don't really want to lose yourself in the thought, okay, what is the asset worth right now? Because the rental agreements that you have with your customers, they are still intact. So why on earth those are not going to get lowered when your assets get lowered? So I feel like in those scenarios you want to have a different payout ratio. And sure, there are several payout ratios, but for me, the operational cash flow, or actually the free cash flow payout ratio, is best. And I would advise any investor that is looking at dividends and to see if they're safe to use the dividends divided by free cash flow to see whether or not the dividends are safe. So that's it for today, guys. Hope you guys enjoyed it. Let me know what you think about this new formula. It might actually be out there already. Like, I would be surprised if I am the inventor of this formula. However, this is not common on any financial website, so I suggest you start using it and use it to see if the dividends are actually safe. If you like this kind of content, please leave a like, and obviously you can also subscribe if you haven't already. And see you guys tomorrow.